And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week. And don't forget, it is just 2 days until our economic summit this Saturday. If you haven't got your ticket yet, be sure and go online now and get your ticket. It's going to be a lot of fun. We actually have a mixer tomorrow night starts at 6 o'clock at the hotel. So all the speakers will be there along with a few select guests. If you buy the ticket, love to have you come by. We're going to have heavy hors d'oeuvres, sit around, just talk, visit, talk about markets, outcomes, whatever you want to talk about. It's just a nice little mix and mingle event. But that's tomorrow night at 6, and then Saturday morning, you get up bright and early, we feed you breakfast, and then we have a full day of conversation, talk about markets, outcomes, economics, just pretty much everything you can imagine. We're going to cover it. Live Q&As as well all day long with Adam Taggart. So we've got a lot of stuff planned for this weekend. So if you haven't got your ticket yet, be sure and do that. But that all kicks off tomorrow. So it's here finally. We're going to finally get this show on the road, and guess what? You don't have to hear about the advertisement anymore. So there you go. It's good all the way around. All right, a couple of things this morning. Not a lot moving on. President Trump has decided to kind of step back just a bit on Iran. So we're seeing oil prices come down today, metal prices down a little bit, just kind of pulling some of the tension out of the market a bit, which is good. Over a dollar rallying a bit today as well. The dollar's been actually doing pretty well here, even despite all the kind of tensions with Iran. Dollar's been holding up pretty well, trading above moving averages and pretty right at fair value at 100. So again, we're pretty close right there on the dollar as well. Yields have been coming down a bit over the last couple of days. Even despite these tensions overseas, yields have been coming down a bit. Money kind of moving into safe havens more than anything else because of what was going on there. So, we saw the markets kind of struggle a little bit yesterday as well. Just again, it's been a pretty quiet market all around. Not a lot of volatility pick up. I mean, we have seen now. Having said that, we have seen volatility creep up here just a little bit over the last week. So we have seen volatility rise, but it's been a pretty quiet market. A little bit sloppy trading in the large cap areas. Equal weight indexes have been doing a little bit better. I'm going to kind of go through some of the comparisons this morning between the large caps and some other markets and see what's kind of going on there. But we are seeing some improvement. We talked about last year that we could see a bit of rotation in the markets, and we're certainly seeing that. So we've seen some movement coming out of tech. We've seen it coming out of healthcare recently, moving into areas like financials, energy, staples have had one of their largest rallies since last October. So we're seeing some move again. That kind of that little bit of that risk-off rotation a bit within the markets. Money kind of moving into those areas. Now, again, these rotations don't happen for a lengthy period. They have their moves, and then we kind of rotate back in the other direction. Yesterday, we saw one of the biggest inflows into Bitcoin that we've seen really over the last couple of months. And Bitcoin ETFs in particular, we saw a lot of retail flows yesterday, very, very big inflow into Bitcoin ETFs. So maybe this is kind of a sign we may start to see some speculative change in the markets, maybe a risk on rotation. So coming out of some of those recent trades that have worked well back into some more of the kind of the more aggressive trades in the market. So again, one day doesn't tell you anything, but I'm just saying is like those are the kinds of things you're looking for within the markets, is looking for this kind of risk rotation that occurs between sectors and various markets and those type of things. That's why on SimpleVisor we do that entire analysis on rotation, whether it's the sectors of the S&P 500 or whether it's factors within the markets. We watch that very closely to see, okay, what's underperforming, what's outperforming, because those will rotate over time. And so, kind of a good opportunity, and just from a kind of contrarian investing standpoint, is kind of look for things that are out of favor, because those will eventually move back into favor, at least for a temporary basis. Vice versa. So again, just those provide you some opportunities to take advantage of some things. Outside of that, yesterday we had PPI, retail sales, we had a lot of economic data yesterday. PPI, of course, we had CPI earlier this week, came in weaker than expected, which was good. We continue to see kind of inflation moderating back down towards that 2% level. That continues to kind of be the case here, even though most analysts were expecting a pretty significant uptick in inflation in December. PPI came in yesterday pretty much on the screws with the markets a little bit weaker on the headline. But again, just we're not seeing that inflationary push. Remember, all those kind of headlines is like tariffs are going to cause all this inflation. We've never seen it really kind of pass through here. But again, we're starting to see these the pressures on the purchasing managers index, as well as the Institute of Supply Management Index, is all starting to come down. And we're starting to see that kind of gravitational pull back towards normality. Again, we had these big surges in manufacturing and productivity, and then inflation and all this because of all that stimulus we had in the economy back during the post-pandemic. But that's all just kind of gravitating now back towards where the economy actually kind of operates here. So we're seeing all that kind of converge here. Again, no big surprises, really no big prints yesterday. Retail sales was very interesting. Because we had a nice print on retail sales, up 0.6. So immediate headlines were, hey, this is fantastic. Consumers are doing great. Retail sales are doing fantastic. That means the economy's really just kind of smoking along here. However, if you look at real retail sales, right, that's retail sales after inflation, retail sales are about the same level they were 3-4 years ago. In other words, we've just been trading flat now on retail sales. And what that tells you is, and in fact, the trend of retail sales is now below the pre-pandemic trend of retail sales growth. So in other words, the growth of retail sales is actually slower now than it was pre-pandemic. And what that tells you is that consumers are not buying more stuff, they're paying more for stuff, but buying about the same amount of stuff that they were 2-3 years ago. So in other words, they're just kind of maintaining after inflation, their actual purchases are about the same that they've been for the last 3-4 years. That's not really growing. And so again, when you kind of look at it from that factor, and again, when you start moving from nominal to real, it tells you a lot about what we know about the economy already, is that the economy's not smoking hot right now. The economy's been just kind of growing, but it's growing at a fairly slow pace. And that's why, even though we see these pickups in retail sales, et cetera, we're not seeing that reflect in inflation, because we're not buying more stuff. We're just paying more for it right now. And that's all kind of gravitating through the economy as consumers are basically, just working to make ends meet for the most part. But anyway, that's kind of what was going on in the headlines yesterday. Bank earnings yesterday as well continues. We've got more. We've got Morgan Stanley, Goldman Sachs, BlackRock today. Some more of the regional banks also report today. So kind of keeping a watch on what's happening with the banking sector. Banking sector has been weak over the last couple of days because headline numbers, the earnings numbers are okay, but there's been some weakness in the underlying books, particularly on the credit side. So again, we're just kind of watching those pretty close. With that, let's talk a little bit about the markets. Here's what you need to know before the bell this morning. I want to kind of take a look at the markets a little bit different this morning. We'll look at performance comparisons to the S&P 500, going through some of the major markets, because just lately there's, of course, over the last month, small caps have been doing very well. We've seen, emerging markets and some other indices doing very well relative to the large cap index. They've been performing very well. And of course, when that happens, we all get very excited. It's like, okay, now it's the time to change. Just want to look at a little bit longer term perspective. So these are just some 2-year charts of what's been going on in the markets. The yellow line is the S&P 500. The red line below this is the comparison index that we're looking at. So, for instance, in this case right now, we're looking at RSP as an example. So the S&P 500 equal weight index yesterday set an all-time high, even though the S&P 500 was a smidge lower yesterday. So, it's like, okay, we're seeing this rotation within the markets. We've talked about this for a while. Walmart's been doing fantastic. We've seen Philip Morris and Altria doing really, really well lately. Starting to see some of those value stocks finally starting to get some love here. So that's bringing that breadth up. So again, as we talk about market breadth, that's been improving. But on the equal weighted index, that's really been doing well. In fact, it hit an all-time high yesterday on that index, but there's still about a 20% gap in performance between the S&P 500 large cap and the equal weight index over the last 2 years. So again, just think about from a diversification standpoint. If I owned S&P equal weight versus large caps over the last 2 years, my portfolio is vastly underperformed because of the size of the mega caps and what they've been doing. Same thing occurs when we look at IWM. So this is the Russell 2000 small cap index. Still, now this index has been doing very well here lately. It's caught up a lot and closed that gap. We had a lot bigger gap earlier on, but we're still running after the last 2 years. The Russell 2000 index is still struggling to catch up with the large cap index, which is still running roughly about an 8 percentage point gap over the last 2 years in terms of performance. Again, small caps are doing well right now, but be careful with that small cap index. They are very economically sensitive, as we talked about before. And while there's a lot of speculative fervor kind of chasing this market right now, 40% of that market is non-profitable companies. So there is certainly some risk in that markets. And if we do see and again, expectations for this year is that small caps are just going to absolutely kill it in terms of earnings. But again, giving their economic sensitivity, just want to be a little bit cautious with that because these stocks are getting very overvalued relative to their index. And again, again, they are very susceptible to downturns in the market. So just want to be a little bit cautious with that. No, you definitely okay to own them right now because they're doing well. Not saying that at all. And again, they've been doing well. Set a new high yesterday as well, like with the S&P 500 equal weight. But again, just be careful of that risk that you take on your portfolio because of volatility. Looking at this, this is the actual S&P 600 index. So this is pure small caps. Very large gap, running about a 22% gap. In performance relative to the large cap index. But again, that index yesterday also set an all-time high. Mid caps, same boat here. About a 20% gap, also set a new all-time high. So again, talking about this breadth rotation in the markets, we are seeing money moving into other markets out of the S&P 500 large cap. So again, while the large cap index has been lagging here over the last few days, seeing some relative performance pick up across these other markets. Again, just be careful though. More volatility in these sectors and you certainly run the risk. Looking at international, running a pretty big gap here, but again, it set a new all-time high yesterday. It's doing very well. Again, this is some of the memes that have been kind of chasing the markets, this kind of rotation in the market itself. Emerging markets actually tracking with the large cap index right now over the last 2 years. So again, emerging markets have been doing very well. They're basically outperforming just by a smidge. That just happened recently. But again, that performance just caught up here. But again, emerging markets have a lot of susceptibility to global growth. Just want to be cautious with that. So again, just kind of maintain your risk balance within your portfolios. But again, we're starting to see some performance pickups in some of these other markets. And again, that's good because we're starting to see this breadth kind of broaden out within the overall markets. That's healthy. We want to see that. And that continues to suggest that this isn't as narrow. We've talked a lot about the narrowness of the markets. This kind of action that we're seeing across these other markets breaking out to new all-time highs certainly suggests that narrowness of the market isn't really that as big of a concern as a lot of the headlines tend to make it out to be. So anyway, let's kind of trip around markets this morning. That's what you need to know before the bell. We'll come back, pick up with Michael Lebowitz. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Of course, it is Thursday morning. That means Michael Lebowitz is joining me as well this morning. Michael, welcome to the show. How are you?
Good morning.
Good.
A little cold, but I'm doing well.
Yeah, what's the temperature there?
According to my computer, 32.
Okay, it's 45 today, but we're going to be in the low 70s today. It's going to be just a nice spring day here in January in Houston, Texas.
But luckily, it's very windy here, so it feels even colder than 32. So
Yeah.
we got that going for us.
Yep. Anyway, so let's get into a few things that are going on. So let's talk a little bit about the economics kind of going on. Yesterday we saw PPI, we saw CPI the day before. Certainly this kind of feeds into the Federal Reserve allowing them to continue to probably cut rates here. So we've actually seen rate cut expectations increase. But did you see anything kind of surprising pop out of the numbers?
Well, I think the CPI and PPI were a little surprising. Not that they were slightly below estimates, kind of in line, but slightly below. But if you remember about a month ago when they put out that first CPI report that had come after about a month or two of no reports because of the government shutdown, it was much lower than expected. So, it was kind of expectations, especially on Wall Street, were for a decent rebound to kind of balance it out. And that's not what happened. It showed that those numbers put out 2 months ago or so were in line with the trend. Obviously, that can change. But I think what it's showing is that CPI, PPI, especially CPI, which has been stubborn, probably in large part because of the tariffs, kind of adding a little pressure to inflation, those effects are finally wearing off. And it appears that inflation may be slowly, begrudgingly heading lower. So I think that's a positive. And, I think you pointed out the biggest point on retail sales. They've gone nowhere for 2 to 3 years on an inflation-adjusted basis. So that's the data we've dealt with. And then the other data is the employment data, which is just showing a very stagnant labor market. So to your point, I think the Fed has room to cuts. They're not going to cut in January. But I think the fact that the market has a 50-50 shot of a cut by July, I think the odds are better than 50-50. And I think they could cut 1 or 2 times by midsummer, if not more, if the economy slows.
Well, and again, that's kind of the big. This is the big story for this year. We saw this time last year. We saw the same type of narrative start out early in the year. It was going to be a year of economic reflation, and small caps, mid caps are going to do fantastic, et cetera. And we saw that same kind of narrative pop up. And then, of course, we got into mid-year and we had tariffs and a whole lot of other concerns that kind of, weighed on that outlook. That's funny, that narrative has now cropped back up here again. We're starting this year with this idea of economic reflation. We're starting to see kind of global economic, the stories of global economic reflation starting to surge. We're going to get a lot stronger economic growth this year. And that's kind of an interesting, kind of byline to all this. And this is why we're seeing, as I was talking about a moment ago, with small caps, mid caps, large caps, international, you were starting to see, these indexes breaking out to all-time highs on this assumption that we're going to have this economic reflation story. But the risk of that story is that, markets have been rallying on the hopes for rate cuts. But if you get an economic reflation, and the word itself means that you are going to get a growth in the economy, which is going to give you growth in inflation. Inflation will pick up with the economic growth, which is going to put the Fed in a much more difficult position about cutting rates, which is what the market's betting on.
Yeah. The reflation story is a little hard for me right now because of the labor market. We're adding, both ADP and the BLS are telling us we're adding about 50,000 jobs a month. But the economy, the population of employable people is rising by about 125,000. We know that there's a big concern, like in these surveys, for people losing jobs. It's not easy to get new jobs. Job openings continue to slip. And it's hard for me to believe that we're going to have this great economy with sentiment that is weak. And it's not just political. Like I know a lot of people get on the University of Michigan sentiment readings, but it's declining for Republicans and independents. And if you look at some of the other sentiment gauges, they're at levels that are typically recessionary. So what concerns me is that we just had a what appears to be a good holiday spending season, but now we're going to get into the frugality where people start retrenching and they hold back. And if you're concerned about your job, you're going to hold back even more. And I think it's going to be hard for that 70% of the economy that's consumer driven to get us really strong economic data. I'm not saying we're going into a recession, but I think that's a pretty big anchor holding down the economy. And if we see sentiment improve, if we see labor data start to get better, job openings rise, people's feelings about their job and their security increase, then yeah, I can buy into this reflation story. But for now, until sentiment in the labor market improve, I think that's a tough sell. That's a tough sell to me.
No, I agree with that too. I mean, there's certainly a lot. Again, part of this reflation story is that if you look at the narrative, the reflation narrative is a resurgence of economic growth with no inflation, which allows the Feds to keep cutting rates. It's really hard to get. Right now, for instance, the Atlanta Fed GDP now is predicting fourth quarter GDP at over 5%, 5.2% growth. It is going to be really hard and that they're assuming, and just so you're aware, the Atlanta Fed, they take the quarter's GDP growth, they multiply it by 4. So what they're saying is that in quarter 4, GDP will grow at 5.2% for the entire year. So it's an annualized rate of growth. If you're growing the economy at 5.2% on a real basis, you cannot have inflation running at 2.2%. That's just, that inflation rate is going to come up. And that's going to put, and again, as I said earlier, that's going to put the Fed in a really tough box about having to cut rates. And if they have to start hiking rates because of a pickup in economic growth and inflation, that's really going to put a lot of this narrative at risk, for the markets.
Right. And that's also well above trend. So, trend is closer to 2%. It's close to 2%. So that leads the other question is first of all, if GDP is around 5% and the Atlanta Fed at times is very accurate, at times it's very inaccurate. But if it's kind of running 4 to 5%, are we due for a let up in the first quarter or two to catch up? I know the trade deficit, that when they announced the trade deficit, the GDP now increased from like 3.5% to 5%. So again, there's still this tariff, the implications of the tariff that are kind of having a huge impact on the economy. If you remember, first quarter, we were negative, I forgot the number, but it was negative GDP. So some of this is still the ramifications of the tariffs and the way it's changing the flow of goods to and from this country, which is, it's legitimate. That's the way they count GDP, but we'll see how sustainable 5% was, just like we said that minus X% in the first quarter of last year wasn't sustainable either, wasn't accurate.
Right.
This may be the kind of period where we have to look over 8 quarters and kind of take an average to really, at the end of the day, really understand what happened.
Yeah, exactly. So, I'm going to let you die on this hill this morning, but I'm going to run the charts for you, but I will let you get into your article that you just published out yesterday morning on the fundamentals or valuation issues with what's going on kind of in the precious metals market. So I will turn it over to you, and I will, as you get there, I will give you your charts.
Okay. So first of all, if you own silver, you like silver, great. This is not necessarily bashing silver. What it is perspective. And Lance, this article came from you. This was your idea. You said, Mike, here's an idea for an article. Why is it that people in bubbles don't see other bubbles? And, you were kind of referring a little bit to the precious metal bubbles. And in my head, I had this cartoon of a guy, a silver owner in a bubble, and looking out at the world of all these other bubbles, but not seeing that he's in a bubble. So, a week or two, kind of stewing on the idea, I said, I'm going to help silver investors, and truly, I mean help, by just showing them other bubbles. I don't, I kind of give a little bit of my 2 cents in this article on silver, but the purpose of this article is really to talk about a disturbing trend. Since about 2020, we've had this, I call them micro bubbles. We've had this rolling micro uh, bubbles occurring in the market where you have a small sector, a niche product, something that goes up 300, 500, 1,000% in weeks, in months, and then collapses. It follows a typical pattern.
Right. So you're talking something like, say, Fartcoin as a good example.
Fartcoin. So I'm going to kind of just go through some of the main categories, and you can just scroll the graphs at will. And
right.
You may be ahead, you may be behind, but you get the drift. All these graphs are the same. So altcoin and NFTs. Remember how powerful that narrative was? That crypto was going to be the dollar's going away, and that it wasn't just Bitcoin. Anything that was altcoin or NFT, the Bored Ape, was going to go to the moon. So, you can see Fartcoin up 660%. Then it gave up 87%. And pluses and minuses don't work the same way. Bottom line is Fartcoin went up and went down in a period of 8 months. Dogecoin, very similar graph. And you're going to notice, you may even ask, are these the same graphs you keep showing over and over again because they look so similar? And my favorite is Bored Ape. Remember the picture of the ape with the silly hat on its head?
Yep. That was those. Just by the way, if somebody doesn't know what that is, the Bored Ape was part of the NFT issuance. We went through this whole period of putting out these non-fungible tokens, and Bored Ape was part of that. But go ahead, Mike.
Meme stocks. Remember those? Wall Street were the bad guys. They were shorting stocks of companies that were on borderline bankruptcy, and that's a no-no. Us, the retail investors, are really going to go after them, and we're going to take the moral ground. So companies like GameStop, AMC, BlackBerry had these massive gains. GameStop was up 1,800%, and you can look at the graph in days or weeks, gave it all back. AMC, very similar. BlackBerry, with, who's had a BlackBerry phone since, the early 2000s?
I think it was more like the late 90s.
Right. And one of the themes that that you see in these graphs and that I'm developing here is that these narratives that sold these ideas were powerful at the time. Even, all of these we said are a joke, but the narratives at the time sounded, you know what? Maybe I should look into this a little more. Some of these sound a little realistic. Maybe there's something to this. Here's a more recent one, crypto treasury companies. Our favorite company, MicroStrategy, now called Strategy. And, again, crypto is going to be everything. The world's going to run on crypto. And if you're a company that owns crypto, you're going to go to the moon. And we're going to pay much more for your crypto, for your Bitcoin, than the Bitcoin's worth. MicroStrategy up 760%. It's given almost all of it back. BKKT Holdings. We know this one, Lance. This was a Japanese company that made, was it robes?
No. So no, BKKT basically invested, basically helped convert a kimono company.
Kimonos, right?
Right, into it's like a 180-year-old kimono company in Japan, and they converted that to a crypto treasury company.
Right. Then we had our pandemic winners. Remember those guys? The Zooms. There were a bunch of those. Peloton, Teladoc. These were companies. Remember the economy in 2020? We were wearing masks. We weren't going outside. We were we're exercising on our Pelotons. We were on Zoom all the time. Netflix. All those things. Clorox was a big deal back then, and the narrative was sold that life was going to be like this forever, and that Zoom, everything would happen on Zoom. So again, I'm showing, you're showing these charts, hopefully, up and down. Now you'll notice that some of these last a little bit longer, right? Some are short, some are long lived, and that's just depending on the strength of the narratives. And we come to SPACs. Those were wonderful, right? Great idea. We're going to collect your money and we're going to get you into companies that aren't public yet. But we're going to sell you those SPACs on the idea that these companies are worth the same as very mature companies that are already making money. And we're so smart as the guys putting together these SPACs, you just have to trust us. It turns out they were, I'm not going to say the word scams, but they were really financially in the best interest of those putting together the SPACs and issuing the SPACs. We show a couple here, Nikola, Virgin Galactic. There were a handful. So I kind of, my last paragraph is to silver. Is silver, what's the narrative in silver? And there's two narratives. One is it's a precious metal. It's gold on steroids. It's gold with a high beta. So is the dollar being debased? And, I've heard plenty of arguments. You've heard our arguments that it's not. But, if you think it is, then there is some justification for silver rising. What I keep coming back to is if the dollar's being debased, why are foreign banks buying U.S. treasuries? Why isn't the dollar collapsing? Why isn't U.S. real estate in a bubble? That's what should be going to the moon, hard assets. So it's nice that silver and gold are pricing in debasement, but why are a lot of other asset classes not pricing in debasement? And bottom line is, you look at all these little micro bubbles, and you can decide for yourself if silver is a micro bubble or not. And there is some decent supply demand stories that the demand for silver has risen decently because of a lot of new technologies, and the supply is capped. It's hard to get new silver quickly. That will happen over time, but quickly it just doesn't come out.
So basically you have a supply demand imbalance.
You have a supply-demand imbalance, which is being goosed by leverage at the exchanges. And that can persist. I'm not telling you it's not going to 120 or 150. I have no idea where it's going. I just think unless you believe these narratives, it's probably going a lot lower in the mid, long term, whenever that is. That could be next week. It could be 6 months from now or a year.
Well, there's also a couple of other factors here, and particularly in the commodities market itself. We just talked about recently the CME is hiking margin rates. They just changed their margin requirements yesterday. And the reason is for two things. One is there is a supply-demand imbalance, and that is certainly the case, and that's the case with all commodities and any stock or anything else. There's always a supply-demand imbalance between buyers and sellers. And so when there's a supply imbalance, two things are going to happen. The price is going to go up, and that's going to bring supply to market. And so that's what happened to the Hunt brothers, right? People found sources of silver, and at certain prices, as prices rise, things that were uneconomical to create supply before, whether it's opening up new mines or recycling other products, solar panels, EV batteries, whatever it is, those were uneconomical at lower prices, but at higher prices, those become a lot more economical. So that brings supply to market. But the exchanges themselves don't want the price. When prices get too high, it creates market fragility within those markets, and you start running the risk of fail to deliver, those type of things, and creates financial instability within those markets. And that's why the CME is going to keep hiking margin rates and working to pull prices back down at some point to a level, probably in the 30s to 40s, where that supply-demand imbalance comes back in line. And again, if we start to see, as a good example, we pulled a lot of precious metals into the U.S. to get ahead of tariffs, but now that tariffs are kind of going away, if silver is shipped back to the London exchanges, you're immediately going to have a whole lot of supply back on that market, and that's going to impact prices. So there's a lot of dynamics that are on a supply-demand basis that can change, not necessarily quickly. And again, to your point, Mike, we could see prices continue to move up here, but at some point that supply-demand balance is going to shift in the other direction. And that's why investors need to be aware that at the end of the day, that's how all this changes. And you can be caught very quickly in a downdraft when markets start running backwards, because there's a lot of short positioning now against silver. And when those start working in the other direction, that's gonna impact that price decline.
And I think this is another literally critical thing to consider. Silver is a critical mineral, not like gold. Silver is unique because it's actually used in some key industrial processes. So the U.S. government, which has put put critical minerals on a pedestal, right? That's part of the reason we're in Venezuela. It's you hear with our fights with China every day. That's one thing Trump has really focused on. You think the administration is happy with one of their critical minerals going up 3-4x in price over the course of a year or two?
It's a national security issue.
Right, exactly. So that's another issue. But the purpose of this article was go back, read the article, look at all the narrative that each one of those sections told you what the narrative was. And at the time, the narrative, there was some, you could plausibility to it. Maybe, yeah, I could see that happening. In hindsight, they're all laughable. So look at the narrative driving silver. Do you buy into those narratives? The industrial metal, the supply demand, the debasement story. Do you buy into them? Maybe then silver is at the right price. Maybe it's at fair value. But take a good look at the narratives, because that's what's driving price. And in time, almost all narratives give way. So you have to understand is if we're at fair value and the narrative kind of fades, then silver may just stay where it is, and that's all good, or it may go up. But that's what I want to kind of get the attention of silver investors, that all narratives sound good, but in hindsight, a lot of them prove to be false.
Well, and again, just a really good example of that. One of the narratives is that look, we're doing all these things now that require silver. We've got solar panels and EVs and all these type of things. That's true. That is a true statement. We have a lot of new things that are coming along that require more silver. So that's part of the supply-demand imbalance. However, when the price of silver rises, so do the cost of all those products. And at some point, the cost of those products, because of the increase in the internal components, go up. The inflation in that product, people go, well, you know what? I'm not going to buy that. I'm going to buy this other thing over here that is cheaper or is different, or I just don't buy it. And demand declines. And when demand declines, that allows supplies to build. So again, it is always a function of supply and demand, but supply and demand will always shift over time because of factors within the economy. Again, the cure for high prices, as is always the case, the cure for high prices.
Right. And don't forget, the marginal trade is happening on the futures exchanges. Those are very, very highly levered, and that leverage is tightly controlled by the CME exchange.
Right. And most importantly, the vast majority of those contracts are not for delivery. They are purely for speculation.
Right. Right. What Lance is saying is that someone may be short a ton of gold today for February settlement. They will get out of that short before then, and longs will get out of their longs. A lot of that stuff goes away, or it gets rolled to a future month. So you're going to hear a lot of statistics about, there's so many short positions and there's not enough silver to deliver. A lot of that will just get rolled into the future, pushing out that problem to infinity. So again, I'm not telling you, I don't think I was telling a client yesterday, I'd rather play roulette than try to bet on silver right now. I think roulette's a much easier game. At least it's close to 50-50. I think silver could hit 120. I think it could hit 40 in the next 3 weeks. And Lance, you may even think those numbers are too conservative. Right. I don't know. But so I'm just trying to, this is just food for thought. We're not telling you silver is definitely going to 20, and we're not telling you it's going to 200. We're just telling you to really think about what's driving it.
Oh, yeah. And absolutely. Look, and just full disclosure, we own silver, we own gold, we own uranium, we own a whole variety of other metals in our portfolios, but we've also been rebalancing those as we've kind of gone along. We just recently, pulled our exposure to silver back to target. Wake took those profits, put those into cash, and we're going to wait for a better opportunity. But that's just part of risk management. Just because we're providing this outline for you doesn't mean, and again, we are never bearish or bullish really anything. It's just we're looking at supply demand imbalances, and when a lot of risk presents itself in the markets, and that's all we're talking about here is risk management, is understanding there are times that the odds of continued acceleration in price, particularly when you have something going parabolic, is not a really good bet. You're kind of playing roulette with 5 bullets in the chamber. You may get lucky and it keeps going up, and that certainly may be the case right now because there's a lot of momentum behind that market. So speculators are chasing the markets right now. As the price goes up, the people that are short, that were hedging, that were arbitraging the metal, whatever, they're having to cover that short, which is driving the price higher. And so you kind of get this feeding frenzy within the markets that drive prices higher. But eventually that breaks. And when it breaks very rapidly. So that's why, we just recently took profits in our silver. Did we sell everything? No, absolutely not, because it's part of our portfolio, long-term portfolio structure. We've owned it for a long time. We're going to continue to own it. But again, just this proper risk management of your portfolio, taking profits, rebalancing risk, that helps you navigate these periods of volatility, allows you to participate on the upside, but then protects you from the eventual downside. And, we'll look, and if you go back, there was an interesting tweet I got yesterday. A guy tweeted me, Mike, and he said that, let's see if I can find this here real quick because it was interesting. He said, I don't know why you own equities because they're so volatile and they just kind of go up and, they can collapse a lot in price. That's why I own just metals. And I was like, kind of, are you kidding me? Because, silver is probably one of the most volatile commodities that's out there and has regular crashes throughout history of 30 to 40 to 50%. That is not uncommon. And, here it is, right? So this was the actual tweet. Let's see if I can get this up on the screen here real quick. Can you get this for me? Just this. Yep. It's as centered as I can get it. Yeah, just the chart, just the middle part.
As you were talking about that, Lance, it reminded me of the people saying the same thing about Bitcoin when it was up at 120,000 or whatever it was.
Exactly. So this is the chart of silver that he put out, and this just goes back to basically about a week and a half ago. And his comment is trust in corporations and their shares is always a roller coaster ride, fun but strenuous. I'd say on the buy side, what's always been considered a hard physical commodity and never really takes big dives in value is silver and gold. And so I was like, okay, this is fine. So I gave him this chart. And so this is a chart of silver going back to 1977. And I've overlaid the correction prices for this, and again, if you start looking at just potential pullbacks to support moving averages, you're trading 5 standard deviations above 4-year moving averages. So, when you get an eventual correction in price, these moves of 30, 40, 50% to the downside are not uncommon at all. And that's why part of risk management is very, very important here, is just understand that risk of a correction is not a possibility, it's a probability. It's just a function of timing until you get there.
Lance, the 20-day moving average on silver, if I'm reading this right, is 31.
Mm-hmm.
Is that right?
I don't have a chart in front of me, but that sounds about right.
There's something wrong with this. It's about 77. Right. Silver's at 90 right now. That's a 13-point drop just to get to the 20-day moving average. It's 76. That's a big drop just to get to the moving average, to get to a very, very short-term moving average. So, it will be incredibly volatile. Stocks are going to look like stocks are going to look like treasury bills compared to what's going on with silver right now. Eventually, silver will calm down and become more predictable, less volatile. But it is in a very volatile state right now, both up and down. Volatility doesn't always mean it's going to drop like a rock. It just means prices are going to vary significantly. And if you own silver, you should expect that. You should expect to wake up where it may be up or down $5 or $10 on any given day. And
look, and this is just a really good point. This comes back to position sizing as well. There was a comment in chat talking about I'm keeping GDXW at 5%. Fantastic. Nothing wrong with that. So the only issue I have with GDXW is it literally is a new issue ETF. So you have no trading history to know what kind of volatility this thing is, how it tracks markets. It's if it's using weekly pay, it means it's using options to get its positioning into place so they can do the weekly pay. So you don't have any history about the volatility of this potential issue. And of course, whenever this thing does a weekly pay, you're going to get a discounted price because it's taking that capital out of it. So 5% of that is fine. Here's my point about this. You've got no history to work with, and what you have to look at is look at your portfolio and say, if that 5% of my portfolio goes to zero, what's the impact to my financial net worth? And again, I kind of went through this a little bit yesterday. If you got a $10 million portfolio, 5%, probably nothing, right? You just $500,000 down the drain, no big deal. I still got $9.5 million. I'm doing okay. On a $100,000 account, 5% may be much more impactful into your future financial outcomes. So again, when you start position sizing your position in your portfolio, whether it's silver or gold or NVIDIA or stocks, and this is what Mike and I do constantly, and we talk about this all the time. Hey, we just reduced our position in silver. It's I think 3.5% of the portfolio. It was like 5. We trimmed it back to 3.5. Because if that asset drops sharply, right, it impacts the total return of the portfolio to a significant degree because of the weight that it has within the portfolio. So again, you want to kind of look at, 5% may be just fine for you, but for somebody else, 5% may be way too much in terms of risk management. So again, we go back to talking about portfolio management, and I encourage you to go to our website and type in portfolio management at the top of the website in the search bar. There's an article talking about portfolio management and navigating risk, and we go through the actual math of building a risk position size in a portfolio. But it has to be something you can actually weather. One of the mistakes that investors make all too often is they allow a position to become too big of a position in their portfolio because of greed, right? It's like, oh, this is going up. I want more and more of it. So I continue to build a concentrated position in that portfolio, and I'm doing fantastic. And then one morning I wake up and the whole thing goes wrong. And that happens all the time to investors, and you wind up losing way more capital than you expect. And that becomes a negative impact to your long-term outcome in your portfolio. Remember, the whole reason you invest is not to build wealth overnight. It's to survive the long-term impact of the market so that you can compound wealth over time. And so if you take on too much risk and you take on something speculative like GDXW that has no history and is using a lot of options underneath it, you've got the decay roll of options. You've got a lot of other problems with that. Just go buy GDX and put 5% into GDX, and you can participate with the miners without the volatility risk, and you've got a lot of history to work off of with GDX. It's something we own in our all-weather portfolio, but you've got a long-term history to work off of. So you have moving averages, and you've got support levels, and you've got areas where you can say, okay, at these levels, I'm going to start reducing my position because risk is increasing in the portfolio, up or down. So you've got these things to work off of that give you a better guide of how to manage risk in your portfolio. Anyway, sorry, Mike, it was a good point in the chat. But anyway, go ahead, Mike.
No, and I would, there's one more bit of advice that I think is probably the most important thing we can give. It's when you're talking about silver, gold, don't take advice from the guy selling you the silver or gold, the coin dealer. Don't take advice from people selling precious metals newsletters. Their whole goal is to make money selling a product. If there was one theme that kind of held throughout all those micro bubbles, there were some people that sold the narratives that profited significantly. So the message is, wherever you get your information on silver, don't make decisions based on why is the guy selling you silver if he thinks it's going so much higher. Wouldn't he want to hold on to it? And the guy selling the newsletter, he doesn't care. He's just trying to sell newsletters. So listen to unbiased opinions, bullish, bearish, whatever you choose, but just understand what the motivation is of whoever it is you're taking the opinion of.
Okay. So now, having said that, let's talk a little bit about markets in general. And then we'll kind of wrap the show up. So again, markets have kind of been sloppy at the headline over the last, kind of week or so. But we've seen a lot of rotation underneath the surface. Walmart has been doing just fantastic as of late, and it's going up sharply. Amazon, which is a direct competitor, right? Online delivery, grocery store, everything kind of thing. Go to Walmart, buy anything you want. Go to Amazon, get anything you want. But Amazon's been underperforming. So it's kind of an interesting rotation in the markets, particularly if you take a look at Amazon and Walmart as a comparison. And just full disclosure, we own both of them. But just looking at you would think that if Walmart's doing well, Amazon should be doing well also. But in reality, that's not the case. And this is showing that kind of rotation we're seeing in the market. I'm selling Amazon to buy Walmart. It doesn't make a lot of sense because they're identically almost the same company. But that's what we're seeing in the markets. We're seeing this in staples in general. You and I talked about back on January the 9th. In our daily market commentary, we said that staples were way out of favor. They were due for a rotation. We've seen kind of the last 2 weeks has been some of the best performance of staples that we've seen in over a year. So we're seeing this kind of internal rotation in the markets, and whether this lasts or not is going to be the question, because it's hard to imagine if we're having this economic reflation story that you're seeing defensive stocks starting to move as well as they are right now, if that reflation story is as baked into the cake as a lot of the analysts currently think.
Right. So, Lance, if you look at our factor analysis, where we're looking at a bunch of different stock factors, the large majority of them are grossly overbought on an absolute basis. However, the Magnificent Seven, mega large cap stocks are not. They're almost basically fair value, zero. So I think, to your point, what we have is a rotation into anything that's not the Mag 7. And the market, I think the market's getting very overbought here. As odd as that sounds, you just don't see it in the S&P 500. You don't see it in the indices because of the weight of some of those big stocks that have been lagging. So I think underneath the surface, you have a very overbought market. But at the surface level, everything kind of seems hunky-dory. So what we may be coming into, and this could persist all year, that these stocks that have been neglected for years kind of stay on the overbought side throughout the year. But at this point, it looks like the mega cap stocks may have a couple days in the sun where they may outperform the market. We'll see. But the market is getting very overbought for many different stock factors and a few of the sectors as well. So, what you see at the surface is not necessarily what's going on underneath. Just like through a lot of the last 2 years, the market was zooming ahead and there were 300, 400 stocks going nowhere. So, this is where a lot of that analysis, that instead of just looking at the major indices and telling you what the market did or didn't do, is very helpful.
Yep, exactly. All right. That wraps up the show for the day. We're going to have a whole lot more conversation about this and a whole lot more stuff this Saturday. So if you haven't got your ticket yet for the seminar, please come on by. We'd love to have you. It's a live in-person event. Got lots of time to sit, shake hands, talk face-to-face, answer questions. We do a lot of live Q&A with Adam Taggart. It's going to be a lot of fun. Everything from financial planning to investing, this reflation narrative. We're going to get really deep into this whole reflation narrative this weekend at the conference. So if you want to know more about that, be sure to get your ticket now online, realinvestmentadvice.com. And best news, you won't have to hear any more about this next week. So there you go. Also, while you're at the website, be sure and like and subscribe to the channel. We appreciate it very much. Certainly helps us. Monday, we've got an interview with Michael Green coming for you. Monday is a trading holiday as well because it's Martin Luther King Day. So anyway, all right, y'all have a great weekend. See you back here on tomorrow's edition of Financial Fitness Friday. And then here back next week as well. realinvestmentadvice.com. See you next time.